So our special guest, Dylan Marma, as I mentioned before, I have a good relationship with Dylan. Dylan's awesome. I know him previously with the Jake and Gino community. He headed up acquisitions there, and pivoted, I think about 2 years ago. It's been about 2 years. We had Dylan as a guest in one of our virtual meetups about 2 years ago in August 2020, to talk about underwriting multifamily expenses. And now he's pivoted to this RV park and mobile home park space. And he's crushing it. Him and his team are crushing it. So Dylan, if you wanted to talk more about yourself, and we can kind of lead into your presentation here.
No, I think that's a good summary. Yeah, started off with apartments and got into mobile homes just about 2 years ago. Yeah, it's funny. I remember very well, the presentation we did. I think that was probably right around COVID, like you said. That's probably when you started it, and then shortly after that, the first deal popped up, and now we are, as of last week, we're over 1,400 units, 15 properties later, and still moving and shaking.
Stop my screen share here. If you want to, you have
Sure.
Slides, Dylan, you want to?
Great. Let's do it. Can you enable?
Yeah, go ahead.
Cool. All right. Great. Well, thanks so much for having me, back here, guys. Super excited to be able to share this with the whole group here. Definitely, this is not a scripted, presentation, so let's keep it, free flowing. If you have questions or thoughts, definitely welcome them. Just feel free to either, unmute yourself or throw them in the chat. So we'll talk about tonight. We're going to talk about manufactured home communities and RV campgrounds. I think we're going to have more questions, it seems like, around the RV campground side of things. But I want to start with the manufactured housing communities, because I think I think they share a lot of similarities, and there's also some differences. So I think it's important to be aware of, the pros and cons to both, and be able to decide, what sort of best suits you as an investor and your overall investing appetite. So, you might see some references to our current fund. That was not intentional. This is more just, going to be an overview here, where I took a lot of the core slides that educate on the asset types that we are currently investing into in our current fund. So about the Equity Group, currently today, we started, first deal was October 2020. It was a mobile home community out in North Carolina. I'm currently based out of Tampa here at our headquarters. Today we have over 30 employees, with 8 or 9 of us on the corporate side. We have, that's again not updated, it's actually 15 properties with over 1,400 lots. We are a top 100 owner of mobile home communities in the United States. And we run the Equity Group, which is sort of our investor facing arm. And then we have TRG Living with it, which is our property management arm. We focus mostly on MHC and RV. So mobile home communities, these are, sort of trailer parks, right? for as many know them as, the stigma provides itself. But the formal name today is manufactured housing communities. These are communities full of, affordable living situations where individuals will own their home. Usually it's a home that's, produced in a factory, and they'll own their home, and then we own the land, and we're providing them with, the service of taking care of all of their utilities, taking care of their landscaping, creating an actual community, and, making sure that they're, live in somewhere that's safe and clean, and all of the above. Why we like manufactured housing communities? Number one, it's supply constrained. There's a lot of pushback, and we've been looking at this more and more, as we do think development right now looks really exciting, because there's been so much demand and cap rates are pretty low. There's a lot of pushback from counties when it comes to the manufacturing or the development of manufactured housing communities. So a lot of people just believe that it's going to bring down the value of their current home if there's a MHC that pops up in their backyard. So there's a lot of protesting about that in local politics that take place. It's an affordable option. So right now, of course, in a downturn, you know, a lot of people are looking for where can I get into, how can I get into some recession resistant asset types? And generally speaking, these perform equally well, sometimes even better during a downturn, because when things get rough, people go down, not up, right? And there's really not too many places you can go further down from living in a mobile home park, right? So while we've watched pricing correct itself in a lot of other asset classes just over the last few months here, we have not seen that in the MHC space. It's been hotter than ever, and if anything, we've seen some prices that we scratch our head at. We've been having a tougher time finding quality deals because everyone's fleeing towards safety right now. And if you look at the historicals and how the REITs have performed, it's been incredibly strong during down periods. So I think that has a lot going for it right now, and that's why cap rates are as low as they are. Just to give you some understanding, that probably cap rates right now are between a 4% and a 5%, whereas about 2 years ago you're probably like 6 to 7, and about 4 years ago you're probably even as high as an 8 or a 9 in some cases, which is pretty crazy, right? So you can see the compression has definitely taken shape, and that was sort of what initially got me into the space, is because I was looking for apartments that had 6 or 7% yield, and I had friends complaining that I was in Knoxville, Tennessee, and I had people complaining to me about how they can't find 20% cash on cash returns anymore. And I said, well, that's crazy. If I could get somewhere in the middle, that just sounds phenomenal, right? So then, sure enough, we started to get in and find, some really quality cash flowing deals. And it's definitely gotten tighter, but they're still out there. I would say the most important thing in this space is this is a game of off market, scrappy deal finding. Like that's what it's all about, right? We've had to fly out to meet owners numerous times before putting properties under contract. We've made thousands and thousands of cold calls. We've made tons of direct to owner interactions, and even when there's brokers involved, it's still usually like a whole different beast in its own way. There's a lot less of sort of the formal everything goes to market call for offers. So I just throw that out there to just kind of give like some perspective, because it sounds like a lot of folks here are used to multifamily, and I think what I'm saying is probably for Juan and anyone else in self-storage, it's probably pretty similar landscape. It's just kind of the alternative real estate assets. So moving on to land leases. Land, as I mentioned, we take care of I should preface with saying we've bought a lot of communities where we own a lot of homes, right? Kind of coming from the apartment background, that was a natural fit for me, was saying, okay, well, we're comfortable going in, we'll buy them and we'll own all the homes, we'll get a construction crew and we'll turn them and then eventually sell the homes off. And that's sort of been one of our bread and butter strategies in the MHC space. It's actually been the majority of acquisitions that we've done. But the end goal is always to get them to be what they call TOH, or tenant owned homes. So the beauty of this is that when you own real estate, right, we all know that these are both appreciating assets, but also depreciating at the same time. And the bulk load of depreciation comes from the physical structure, the building itself. So by selling off the actual structures and having them owned by the tenant, now the tenant is going to be responsible for the upkeep, the roof replacements, the HVAC replacements, taking care of the floors and so on. So they are now going to repair the homes themselves, and now you're, as the owner, just responsible for the infrastructure itself, the utilities, the roads, the signage, and the community management as a whole, which means that you have radically lower capital expenditure risks than you do with more property intensive asset types. And then the other side of that is that you get low turnover. So low turnover happens because they own the home, and it usually costs oftentimes at least $5,000 to move their home. So they've bought the home, they have significant skin in the game, is usually their largest asset, right? Just like homes are for most people. They've spent $10,000, $20,000. We're seeing used homes sell for $30,000 and new homes sell for $65,000 plus, depending on locations. And they have these homes. In many cases, they either have loans on them or they bought them for cash. and they don't want to move it, right? They don't. Oftentimes, this is affordable housing, so they're not going to have a ton of discretionary income to just to pick up and spend $5,000 to move it every so often. They're probably going to want to stay there for a while, and that's why the average resident stay is usually 15. Can be 10 to 15 or 15 to 20 years, depending on who you ask, right? So it can be a very long average length of residency, very, very low turnover. So that compared to the 50% turnover that you see in multifamily apartments is just phenomenal, right? So I think it's a really, really sticky income stream, right? I like to say that it's not about how much you cash flow. I think what people don't always focus on is the durability of your cash flow, right? And really, you should be paying a lower cap rate or a higher multiple for an extremely durable form of cash flow. I think that's what all the big institutions have realized, is that this is a really durable form of cash flow because you're supply constrained, you have low turnover, you have low capex risk. So it's one of the most consistent, forms of cash flow available in today's real estate market. So I think it's been a big, and I have, what's the turnover for RVs? So yeah, we're gonna get to that in just a little bit. It's definitely a higher turnover because you don't have the same level of constraint to, you don't have the same barrier to moving, right? They're on wheels, they can move at any time. But there's different types of RV campgrounds. So some of them are almost like hotels, some of them are more like apartments. So we'll touch on that more later and get into that. Couple numbers here, just to give some broader perspective. The average monthly site rent is $576, whereas the monthly one bedroom apartment rent is $1,216. I feel like that's actually a high number. Most of our markets are still sub 500. We're buying mostly in the Southeast. We're in mainly North Carolina and Tennessee. And we haven't seen too many markets over 500, but we are buying one right now. It's in Tampa. That's going to be 650. So it all obviously just depends on location. But you can see that, big difference versus where apartments are renting. So it is, lower total cost. The cost of manufacturing, the time I initially put these slides together, it was even, I think, more eye-opening because we were hitting like the early stage supply issues, and I think MH continued to be dramatically cheaper than a lot of the stick built product is, but MH actually hit a huge supply snag as well. And prices did go up, and now they're coming back down, and they're becoming more available for new products. So I think it's followed a lot of the same supply chain issues that you've had stick built homes following. I think that as labor costs continue to go up, though, that'll help us keep costs low because of the more streamlined manufacturing process. Then the all-in expenses. Probably one of my favorite parts is that the expenses are extremely sticky. As you can see that on the chart, you can see the capex as a percentage of revenue. You have 3.6%, whereas with multifamily it's 12.2% of revenue, and this is your below the line. So I think a lot of people just look at the NOI, but you have to look at how much money is getting spent below the line for your capital expenditures ongoing, because that's limiting your distributable cash flow. So by having really low capex, you have consistency in your expenses, and you also have more distributable cash at the end of the day. All right. Any questions on mobile home communities, or should we jump into the campgrounds? All right. Cool. So yeah, let's go ahead and jump into RV campgrounds. Let's first start with this is a highly fragmented industry. So I think what's especially interesting about this space right now is that the amount of mom and pops out there is just it's staggering when you start really poking around and looking at the ownership of most campgrounds throughout the country. Florida is the one state, frankly, that was bought up really, really heavily by the institutions. ELS and Sun are the main two institutions we try to follow. We try to read all their reports and kind of see what they're doing, because they seem to be the the thought leaders and the the big money in this space. But they started with buying up Florida over the last 20 or so years. But a lot of these other states are still, and there's still opportunities in Florida, but a lot of the other states are still extremely fragmented, extremely heavily mom and pop owned. And it almost seems like there's loss to lease around the entire states or entire markets, right? Like it's like no one's actually raised rents in 10 years. So everyone's sitting there at, $250 a month when it's possible the demand is there for $400 a month, right? Or something along those lines, right? Which I think that's just where the opportunity lies. I think this is similar to where, the mobile home park industry was, I don't know, I don't like throwing out exact numbers, but let's say like 10 years ago, right? Think about where, storage was at one point. And I think the campground space is definitely lagging behind other alternative asset types. I think it's harder to figure out. I think there's a natural barrier to entry because there is the operational aspect to this. It's not rocket science to run a tenant-owned mobile home community, right? Because your main role is collecting rents and making sure the lawns are mowed. Whereas RV campgrounds, you're going to have higher pressure to perform well and provide good hospitality. And we have endless event schedules. We'll talk more on some of the different value adds opportunities that we put in play. But there's a little bit more of an operational element to it. And I've had just a ton of people that have been in the mobile home community for years that are just like, I just can't figure it out or can't understand them. I think it's just got a barrier to entry. So that's probably what's kept it heavily mom and pop owned over the years. Then you have high cash on cash returns. So this depends, definitely want to caveat this with, depends on if it's long-term or short-term. On a long-term RV campground, going back to one of the questions we had regarding the turnover, on a long-term campground, we would anticipate more similar turnover numbers to that of an apartment complex. It's possible that they're lower turnover numbers, but I think as a safer assumption, if you're on all annual site agreements, or some states would be seasonal, if say they're closed down for the winter, then having somewhere in that 50%-ish turnover is probably more than likely. The nice part is that you don't have the capex of having to go in and do heavy unit turns and renovations when someone moves out. So you still have that going for you, but you do have a little bit more of an active lease up period. Now, again, there's pros and cons in every aspect, right? Because that also means, on the flip side, that means we can increase numbers quicker on an RV campground than a mobile home community, right? One of the biggest challenges that we've ran into as owners of manufactured housing communities is a lot of our residents are on fixed income, right? And we try to be sort of community conscious of, not raising rents and putting people, like not doubling rents overnight or putting people in tough positions, right? So we have to be really thoughtful of how do we gradually close the gap to be able to get to market, or help with cash for keys if they are in a bind. And whereas with campgrounds, it's similar to apartments. They have an option to leave, right? It's completely up to them if they want to pay the price that we're charging or if they want to leave. So you can much, I'm not saying we go to market overnight, because we usually do reward legacy residents in some fashion, but it's much easier to be able to bring it closer to market and close the gap on loss to lease. And you have usually a higher income demographic on average, obviously depending on the campground. So I just think it's important to know, like, yes, they're more liquid leases, but more liquid leases aren't always a bad thing, especially in an inflationary environment. That means more material, increases in income sooner, right? So I think it's just important to kind of weigh the pros and the cons of the two. But we think the stickiest ones are definitely annual site agreements. We try to run a 70-30 model and keep about 70% of our portfolio on annual site agreements and 30% on more either monthly or open for short-term sites. That way we can get a little bit of the alpha, the extra yield from some of the short term, and then also get new exposure, new people seeing our campgrounds so that they can later become long-term guests of ours. But having the long-term stability to cover our debt service expenses and so on, right? So again, high cash on cash returns. Just going here, we have a question. I'll try to keep hitting these as we go. That's okay with you guys. We got pros and cons of buying land and developing RV versus trailer park. Yeah, I mean, I think if you're going for maximizing your exit, I think the mobile home communities are probably going to get a better exit because there's more buyers out there and it's an easier industry to price and understand. So if you were going to develop from scratch, I think developing a mobile home community is definitely really attractive because you could sell an A-class off to a REIT at like a 4 cap, right? Maybe lower, who knows, right? So I think you have serious upside that's really easy to calculate just given the way that market works. It's just a simpler industry in that sense. So I think if you're kind of like building to flip, then that's probably the way to go. If you're building for cash flow, I think the RV campground's better. I think if you want to hold it and have a nice business that produces a great yield, I think RV campgrounds are likely better, and that's for that kind of a model. So I think it depends on what you want to do, but just know, like, if you're building a mobile home community, the biggest thing you have to make sure of is this an area that I can sell off new homes? Is there demand? Putting out test homes or test ads to sell off new homes at market or above market prices, I think is really important as a feasibility study. And then the RV development is going to be more of it's a little bit of a slower lease up period. And it requires like a decent marketing budget to get, the people to really learn about it, to hear about it, and then to keep coming back or to get their annual site agreement. So just know it's, I would definitely make sure you have a good runway to get it to where it's at its, the right occupancy level. And then another question is your take on the interest rates and unique factors, interest rates or percentage of interest and unique factors in the RV park model homes and tiny homes in facility. Okay, I see what you're saying. So it's more so, how many people have interest in park model homes, and do the majority of RV parks prepay annual lot rents? Both great questions. I think these are be valuable for everyone. So the first question is relating to how we should fill what the sort of the unit mix is, so to speak, of a campground. How many should be traditional RV sites, and then how many should be park model homes? Park model homes are one of my favorite parts about RV campgrounds. These are made oftentimes by the same manufacturers as those that build traditional manufactured homes, but these are 400 square feet homes that are on wheels, but they have skirting, so you wouldn't recognize it, and they look like tiny homes. They're actually really stylish. We looked at some this morning that were contemporary, that were just looked incredible. And you have all different shapes and sizes and styles. You can get beachy ones, you can get ones that are more built for the mountains, and you can get really creative with them. And the benefit of these is that they're ready to go on wheels, ready to be delivered, and you don't need to deal with any planning and zoning. You don't have to get any permitting because they're RVs technically. So you can take RV sites and quickly fill them in without waiting a year to get back. Obviously, it depends on where you're at, but I know we've dealt with all kinds of red tape and headaches with planning and zoning. So the fact that you can just, as soon as you have the homes, you can bring them in and just put them into existing sites and connect them to existing infrastructure. I think it's incredible. And I think that if you look at that on a short-term rental model, it's a cash cow. We recently bought a used park model home at one of our properties that we bought for $18,000 and we're renting it out for $185 a night. The thing's going to pay for itself in, a year's time, right? So I think that having some makeup of the short-term rental aspect, and we have, we're on all the major booking sites and we do quite a bit of short-term rentals. I think right now we have close to 20 short-term rental homes, roughly about 20, and between a couple single family homes and a lot of cabins and park models. And we have actually 20 more on the way that we've ordered of these park model homes that we're going to, put into our communities. My objective, I usually don't underwrite the income because it looks so good, but I think that having, say, like 5% over time, building up to 5 to 10%, I would just probably start small and kind of like incrementally add additional homes using third-party financing to fund, and have that just over time build up a nice cash flow. And then if you're in a really good market, you also can sell off the park models. And I was actually talking to one of our guys here in the office and earlier about this, and was sort of talking about like the beauty of these campgrounds is you can have sort of a diversification of risk in just the way that you lay it out in the first place, right? Now, if you wanted to talk about like what is the least risky site type, what is like the blue chip stock of site types, it's the park model that you sold, right? It's the tenant-owned home park model, right? They've bought this park model. There are costs with moving it and setting it up somewhere else. It's this tiny home. It's, pretty much fixed in its location. They're not going to go, they're going to have the lowest turnover out of anyone else in the entire community. And, they have this just a vested interest, aligned interest to be there. So those are the stickiest by a long shot. And I've seen some institutions pay some really aggressive prices on RV campgrounds that turned into complete park model communities that are full of, snowbirds and people that just, live there half the year, that kind of thing. So, especially in the waterfront. So great point on the park models. I think it's really valuable for everyone to be familiar with that. And then do the majority of RV parks prepay annual lot rents. So it's actually not uncommon for people to pay for the entire year up front. I think we give them 5% discount if they pay for the whole year up front. We've had some of our waterfront sites. We've actually had some of our sites do over $12,000 for the year paid up front day one, which is just an awesome thing, because then you don't have to deal with all the collections and the headaches that come along with that. We're still trying to dial in what the ideal strategy is, because we have some communities that are just high income. They'll all be happy to pay up front for the year. We have some that we're uncertain whether to do quarterly or every 6 months. It's pretty common to see a lot of the 6-month strategy. They pay every 6 months. And that's called like 6 and 6. And, that's probably the most common strategy that we see, for the long-term sites. So what else? Yeah, then we got, with the RV parks, are you placing a park manager on site? What about reservation system like CampSpot? Do you do short-term rentals on your park models? Yeah, we absolutely have a park manager on site. Payroll is your biggest expense. I would not shy away from having a healthy payroll budget, because this is a pretty hospitality-driven business. We do events almost every weekend. I mean, we have something going on at one of our campgrounds every single weekend. And if they're big enough campgrounds, they have at least one, sometimes multiple events going on every weekend, to keep, the overall sort of customer experience, where we like it to be able to keep people coming back and create, just great experiences for everyone. Like I know last weekend they did like a farmer's market where they're running around, I think they were handing out some free fruits, vegetables, selling some. It was just like a farmers market themed weekend. Weekend before that, or 2 weekends ago, is Pirates weekend. There was a pirate theme. We do all sorts of like, like October, there's like 3 or 4 different. There's Halloween by different age groups, and it's like a whole month of like Halloween themed weekends. Giant 4th of July things that are special to like some of our areas. We have like shrimp festivals and all kinds of things like that. So it's a really hospitality oriented business, even on the long term, because that's what keeps them sort of coming back, and that's what creates community. And I think creating community equals retention. So I think that's really important to be thinking about that. And then we are currently using CampSpot. It's a good platform. We use something else for our short-term rentals, but we do short-term rental our park models.
Hey guys, just interrupt for a second. You guys can put it in the chat, but you guys feel free to ask Dylan questions and speak up.
Sure. Yeah, definitely.
Right.
How does seasonality come into play for the campgrounds? How does that affect vacancy and cash flow? Yeah, good question. So it all depends, right? If you're a long-term annual site agreement campground, it could be completely flat. Your income could be completely flat all year. But the more short-term you have, the more seasonality is going to weigh in. And every campground, most of ours are, the peak season is July. So we just got through the peak season, and the low season is January. And pretty much after July, with the exception of usually it goes up a little bit in October and it dips back down again until January. And then January and February are slow. And then March starts to shoot up again. And then it keeps going up until July, right? So, and then, if you're in Florida, it's going to be the opposite. You're going to be really busy in the winter time. And then summers in Florida are hot and everyone wants to go explore elsewhere. So that's the slow season. So I think you just got to be familiar with your market. And I like to just go on AirDNA and just look at the trends there, right? I mean, they have so much data through Airbnbs that the short-term RV sites or short-term rentals are going to oftentimes model what the rest of the country is doing in terms of the swings in occupancy.
Dylan, to kind of answer the question too, the cash flow fluctuates with the seasonality.
Yep.
Hey,
yes.
Hey, Dylan, I got a question.
Sure.
When you're looking at buying an RV, what's just your general metrics, your napkin analyzer when you're going in and looking at these on the front end?
Yeah, sure. So when buying one, I'm trying to think what the like what are you trying to hit? What is your expense load? That kind of thing. Yeah, so I'll give you guys a couple rules of thumb. I feel like this is my ever evolving playbook, but we're slowly starting to form some baseline rules of thumb that seem to be helpful when evaluating these things. Number one is you have to look at, first start with the comps, right? Start with the property. And if the property is being run like mom and pop and it's 50% of, what it could be, you'll know that because you'll start looking around the market and seeing what the comps are doing, and then find out what you can gauge the market rate to be, right? And you're either going to find the market rate in the form of a site nightly rate, or you'll find it in the form of a monthly rate, or you'll find it in the form of an annual rate. The biggest mistake that a beginner could make that would hurt them tremendously is thinking that a monthly rate is the same as an annual rate, right? Like if you run a model with a monthly rate at 90% occupancy, you're probably going to get crushed because you're just not going to hit that occupancy level, right? Depending on the market. But so you have to dig in when you're looking for the comps to figure out, okay, like what if they tell you this, it's $800 a month. I usually find that the annual rate is about 65% of the monthly rate. So if it's $1,000 a month, my annual rate is probably $650 a month paid up front for the year, or paid monthly, right? Whatever the preferred payment form is. And then if you want to get to the nightly rate, usually you would you could divide the monthly rate, not the annual rate, but the monthly rate by 15. right? So just for like some quick math here, if you have it's a real common like nightly rate around the country is $45, right? So if you take that and you multiply that $45 times 15, you're at $675. So if you wanted to charge someone for a month, you'd probably charge them 15 days, right? Kind of similar, because if you're going to use a rule of thumb on occupancy, running it all nightly, you're going to go with about 50%. That's usually the case, right? Some people, if you're in a softer market, you might go lower. Recommend going that much higher in most markets, but you could go a little bit higher. And 50% is kind of the rule. So it's like, okay, well, I'm going to charge you the same rate I'd get if I ran this at 50% for a month, right? So you pay $675, and then the annual rate, like I said, is probably about 65% of that. So that'd be like $438 per for the year, paid monthly, right? $438 per month, right? So in terms of the occupancy levels, that's the hardest one to track. I think it's not that hard to kind of calculate. I've seen enough like patterns with that where I think it's that those assumptions are fairly consistent, give or take, obviously, but the hardest part is the occupancy. So, once you kind of know like what your rates that you can charge are, what do you think the occupancy is? And there's some markets where you see these annual or seasonal sites that are 100% occupied, and then there are some where there's no seasonals, right? We find that the stuff on the waterfront is usually the stickiest, and it's most often where we find the 90% or higher occupancy. It's these markets that are either on the oceans or major lakes, major bodies of water, where people want this to work like their lake house or work like their ocean house kind of thing, right? And it's like the most affordable form of a way to get away and have a spot on the water. We recently dropped a deal today, actually, that was in a great kind of touristy destination, but it was just, there was nothing besides like a nice backdrop with some mountains, and I couldn't get there because the market was a little bit more tertiary. And how many times are you going to go every weekend? Are you going to go and just look at the mountains? Like you need something to do, right? And being on the water, usually most people have boats and they're going to go boating and fishing, or just kind of hang out by the water. And I think that makes for the stickiest markets for that model we like, which is that longer term annual site model, and that's sort of mirrored somewhat off ELS, as they're sort of in a lot of our markets, and the majority of their properties are either on the coast or within 10 miles from the coast. So we've definitely sort of taken that out of their playbook to some degree. And then the
Dylan, ELS is one of the big publicly traded.
yeah, Equity Lifestyles, which is Sam Zell's company. He ran Equity Residential, and then Equity Lifestyles is his mobile home and RV and marina company. Yep. So I guess I say all that just to say that like that's the hardest part, is getting clear on the comps. You drive yourself crazy doing this, because like we've done this numerous times where you're trying to get into a new market, and the best thing to do is save every piece of data that crosses your desk. Like if you're looking at a market and you get a broker package, this isn't going to be like, oh, I can just throw it out and check out CoStar later. It's like save every little piece of data you can possibly get your hands on, because there is no CoStar, there are no good databases, and this isn't like mobile home communities where you can kind of just like set the price sometimes. This is like a very dynamic business where I think having like some clear-cut P&Ls of competing properties is, at least what we've found to be the number one way we've been able to get comfortable with this, is we've usually been able to get our hands on some P&Ls of other properties in the area that are sort of setting the pace for where this potential property we're looking at could be. And then once you're in a market, it's way easier, because you kind of have like a general feel for how the market's operating and that kind of thing. But getting into a new market and trying to pinpoint occupancy and that kind of thing are tough. I'd say like it goes back to, obviously, I think like the whole buy on actuals thing is something that a lot of like the world is a lot of the world is pricing in the value add more than anything, right? But I think if you're getting into a new market, it really is like buy on actuals, make sure you can live with like how it is currently performing, unless you have like really material evidence that you're going to be able to improve it. And then, buy on actuals, but have the, hope that you be optimistic that you can improve it. Right. And like, see what that looks like, kind of thing. That makes sense. And then for expense ratio, it's usually about 50% expense ratio. I don't love expense ratios because sometimes it can be materially less. Sometimes it can be materially more. Like I see certain areas in the Northeast where deals trade for $10,000 and the income is so low that our expense ratio is 100%. Like they're getting $2,500 a year, and that's usually what our expense load is. It's usually about $2,500 per site per year. So I think I look at the expense all in number more than the ratio, and I usually see about 2,500-ish. But a 50% ratio, if you're going to give a ratio, is probably a good ratio to give. And the number one thing is don't sell yourself short on payroll, right? If you're going in and you want to be cautious, just make sure you staff this properly, because really, to be a good, well-run campground, you usually need at least 2 full-time people. And that means that if you're buying something that's 50 sites, like it's going to be tough. You have to find like work campers or a working couple that might be able to kind of split up the duties. There are work campers everywhere. I mean, it's a great thing is that people will come and somewhat work just to pay off their site, or work for a very low hourly rate just to kind of contribute and do some part-time work, which is great for us. But to rely on that as like our sole form of management could be really dangerous, I think. So we try to go for something that we can definitely afford: 1 full-time office staff, like a campground host, and then 1 full-time maintenance as well, who often will do the landscaping if it's smaller, and kind of all of that. So hopefully that's helpful. Let's
Anyone
see.
have more questions? You have more slides, Dylan, or?
I do have a couple more. Yeah, I just
Yeah,
jumped
let's
off
keep
just
going.
so we can talk through that. But yeah, let's keep going. So yeah, there's different types of campgrounds. I think I've sort of explained this at this point, right? There's your extended stay workforce housing. We closed on one about 2 weeks ago, or actually late last week, that is more of this model. Like they're a lot of month to month. We're going to start offering more annual sites, but they're traveling nurses. There's in our case, the military in that one. We have some of ours that have Amazon has a camper force where they actually Amazon will pay for their site rent. I believe it's Sears that also has a program to support campers. Sometimes there's oil and gas. These can sometimes be referred to as man camps. And you definitely want to be careful about getting involved with ones that are, high yield oil and gas boomer bust kind of markets where they're all coming from the same industry. The key here is if you're going to get into extended stay, try to be in a really diverse market where you're pulling from different pools, different audiences. They can be great. I mean, they can be really solid, great workforce housing with great yield, and oftentimes pretty high quality tenant base. And we have definitely traveling nurses that make over 100,000 a year that will stay at our campgrounds for extended periods of time. So I think they can be great, but just look for diversification. Second home, I probably come up with a better word for this, but that's more of the model that I'm talking with the annual site agreements, but they don't allow people to live in their campers. It's more there for the weekends, for the experience, for the community. And those I think are all about location. Getting on a major body of water, I think, is really important. It's ideal if you have a marina, some water, some boat slips or storage. I think it's even better. Then you got short-term campground, which is more your traditional campground, which can be ran primarily nightly. And then you got short-term resorts, which are your, upper class, higher end resorts, which, can push maybe your short-term campground average nightly rate is probably 45, 55 bucks. Your resort rate is probably like 90 to 100 bucks or more, right? I'm just kind of throwing out total broad stroke averages. But you're paying a higher rate. You're going to get more, big rigs, more A class. So you got to make sure you have the right utility infrastructure to support that. You're going to have higher quality staff and service, just because they're going to have higher expectations of what to get at that. And yeah, I think for us, we like to be more in the middle, like kind of between 2 to 3, kind of leaning mostly towards 2, but we have a little bit of each in our portfolio. I think it's good to just have general sort of blend. Let's see. A couple great stats. Oh yeah, I wanted to point out one thing too on this side. The beauty of this is that any of these, no matter what we're running, we're going to say that they're not allowed to live there full time. They're going to be there this is a temporary living situation, as that's what campgrounds are designed to do. And they're not allowed to have their mailbox on premise. And by doing this, at least in the states that we operate in, you're able to work through hotel motel laws, which means no formal eviction process, right? I mean, again, this is not legal advice. Obviously, talk to your attorney, and I definitely don't have this down, and for every single state we're operating in, but that is the general premise, and that's what I think a lot of campground owners like about these is that you're running hotel motel laws, which mean you can give 24-hour notice to get someone out, and you don't have to deal with the the headaches of traditional evictions. Moving into so avoiding evictions and avoiding planning and zoning when bringing in cabins, two things I value. Then when it comes to just some great stats. I mean, if you look at I guess I'll just speak like broadly to the industry as a whole. I'm not going to act like everything's like, pie in the sky every single direction. I think there is some uncertainty, mainly on the short-term RV side of things, like as to volatility, that there's some turbulence that is to be expected, similar to how there is right now with just short-term rentals as a whole. I think if you look at the last few years, if you look at even decades back, I don't have it listed here, but decades back, the demand has been steadily creeping up, and I think that in the last decade, it's been visible that you can see the growth in the RV sales. Of course, you see a dip during COVID. But then everything spiked back, and in 2020, if you look at a lot of campground P&Ls, they'll reflect very similar to what the RV sales do. 2020 was like the worst year, right? It kind of took a big dip because there was like the 4-month period that no one wanted to leave their house. Then after that, it spiked right at like unprecedented levels, and then it continued on, and then it sort of leveled out. I think you'll see a lot of them that sort of leveled out. So I wouldn't base your go forward purely on 2021. I would base it on I would base it on looking at historicals before COVID, after COVID, and just trying to get like a blend of what you think the right level of historical sales is. Then you have let's see. Yeah, just thinking through that. Yeah, I was gonna say that as far as like forward looking goes, you are we're seeing right now we're seeing a lot of demand across the board. We personally haven't seen too much slowdown. We have had a handful of calls that have said they're canceling because of gas prices. That was more so a few months back. But as of recently, sorry, they're doing trash in here if you guys have any background noise. As of recently, we haven't had that being an ongoing issue, and we've done a lot to try to really position ourselves to push for more of those annual site agreements, more of that long-term model, because that way they'll leave their RV on site, they'll drive back and forth to the campground, and gas will become less of an issue. And it's much cheaper than a traditional vacation. And I think that that model is very alive and well, and I think the short-term model, we still are doing very well on our short terms, but I think I think if I was to say like, where we're going to place the most confidence, it's definitely the long-term model. And I think there's more volatility just inherently with shorter term leases in anything you do. So I think that's just something to be aware of as, I think that's where I think a lot of operators in this industry are sort of keeping their, where they're keeping their eyes on the pulse. Couple other major stats. You got $14 billion backlog in orders with Thor Motors. That was last time I checked, which was probably a few months back, but huge amount of demand from the consumer side. Places us with about 9% of households in the United States owning an RV. Yes, there's a ton of product out there, and people are going to need them. Want somewhere to place these things, and there's just a supply and demand imbalance. There's if you watch, a great way to learn about the space, because I wasn't an RVer before getting into the space. I'm still not an RVer today. I've done it numerous times at this point to learn and get the experience myself. But the way that I started learning was just watching YouTube videos, right? There's all these vlogs of people that RV and they will share their experiences, and a common theme that you'll hear is they're complaining about the fact that there are no sites, or that you can't go on a spontaneous weekend trip anymore because everyone's booked out for the next few months, right? So that, I mean, that as investors, that's a great sign. We love that, but I think it's just good to familiarize yourself with that, and that'll help, I think, help build confidence with the overall level of demand. But I know that there are certain areas in the country that seem that they could be overbuilt as well, right? We've also seen some markets where there just isn't that level of demand. So, proceed with caution. It's not the same level of demand everywhere you go. I think buying in markets where you have some barrier to entry is always helpful if possible. And then if there's, whether or not there's barrier to entry, having like something that's really there to draw them. And we personally like optionality. And the best markets for us are markets where in a total crisis scenario, we can pivot to being affordable housing and allowing people to live there, to be able to kind of weather the storm, and then also being there during good times as a recreational option for people. So you can see here, there's a few ways that we add value for each of these. Probably hit on a number of them. We'll just touch on mobile home communities. We already talked about park-owned homes. We can infill vacant lots, bringing homes into new lots, leasing them up. We can increase the rents to market. We can build back utilities. We can host events for residents. We try, in our mobile home communities, we try to bring sort of a lot of what, say B-class apartments brings to their communities with resident events and things like that. And definitely feel like it helps separate us. We can add additional sites, both mobile home or RV. One of the big opportunities is that if you have a piece of land that's zoned to add additional sites, I think you can have some serious upside without the same risk as traditional development. We'll charge fees for having pets. We'll install playgrounds and dog parks, enhance the lighting just to make the community safer. I think that goes a very long way. Of course, evicting all of the sort of the bad eggs once we get into a community, requiring background checks, etc. Installing new signage. And on the RV side, we talked about several of these, but increasing occupancy, I think, is really important. A lot of these mom and pops don't even have websites, or if they have a website, there's no online booking. So you have to call in to book, and they're organizing it all on back of a napkin. And I think that just simple things like getting a nice clean website, getting online booking, right? 40% of bookings today take place directly online. Then having Facebook and Google ads, those are our number one paid marketing source, right? We get most of our traffic through organic traffic. But when it comes to paid marketing, Google is number one by quite a bit. Facebook is second. So we track those every month. We put, $1,000 plus for some of our larger properties, $1,000 plus per month in an ad spend. And I think that goes a long way. We have dynamic pricing, just like you have on hotels or airlines, where the pricing goes up and down with demand. If we hit a certain occupancy rate, we can have our prices go up automatically, and then we can have them go down automatically at a certain, if we're missing our occupancy targets. I think that definitely helps optimize the income. Talked about park models. long-term and short-term rental cabins. Golf carts are great to be able to get around. So in larger communities, you'll have golf cart rentals. We also have one that has kayak rentals on a lake. You have site lock fees. So if someone is really particular about wanting to be next to the lake or something like that, they can pay a fee. We've actually charged up to $100 just for them to choose which site in the campground they want. And that can eventually add up to make some pretty good other income if you have some short-term sites going on. And I'll hit on this, then we'll hit the next question. We touched on group events, campground stores. So stores oftentimes big campgrounds can generate 100,000 plus from campground stores selling merch, selling food and beverage. I look at a lot of this stuff like this is just like really high quality amenities. You will make good profit margin, but it's more about just creating just world-class experiences. Less concerned about making a huge profit margin on our stores as much as I am creating the bulk of our margin on our site agreements. So that's where most of it comes from, but it is really valuable to offer all these services, because when you're stuck on a campground, sometimes it's really tough to get food, and you got to get in, no one wants to get in their car and drive. So I think having something that's there as an amenity, I think goes a very long way. And then it doesn't hurt that you make a little bit of profit on that as well. And you can probably, you can usually charge above average prices because for the convenience factor. We get a question on how much are you spending to turn a POH to a TOH? So how much are you turn a park owned home to tenant owned home? And then when you turn a park owned home to tenant owned, do the tenants buy it for cash, or do you provide financing? How does that work? So yeah, I mean, usually we're hopefully making money, not spending money when we're converting it to be tenant owned home. We're usually selling off the home. If the question is more like how much are you spending in renovations, really varies on the condition and the quality of the park. Could be 6 to 10,000, just kind of throwing out numbers for the reno to be able to get it to the condition that you'd like it to be, to then go ahead and sell it. They're usually more expensive to reno, and they take longer than traditional apartments, so just something to be aware of. And just because they're more fragile, you have more subfloor issues, more water damage, etc. But yeah, so always budget to have money in there for renovations, because you're going to get a lot of them back in really low quality, and you're going to have to spend money and time to fix it and then sell it off, and hopefully you're making a profit on the sale. And you can go on Facebook Marketplace and just look at how much used homes are selling for in your market, and that'll give you a good sense of how much to upgrade it and what to try to sell it for, and so on. And then when you turn park owned home to a tenant owned home, do they buy it cash or provide financing? Yeah, so it's pretty common. People will pay cash. We've had people pay cash for up to $30,000 for used homes. So you definitely do see a lot of cash sales. We also see it's pretty common that operators, we've done this as well, where they'll offer like a rent to own strategy, where we're not effectively being the bank, we're offering them a loan, but we're offering them a rent credit where they can put down a down payment or something that functions similar to one to give them initial credit, and then pay monthly, and over period of time be able to sort of earn their way to have the option to purchase the home. And that's fairly common just because there are not a lot of great third-party financing options, but there are third-party financing options, especially when the homes, I believe that the threshold is usually like 10,000 or more for the home, which most homes in today's world should be selling for. You have 21st Mortgage and Triad are two of the big lenders that are very, very popular out there.
Hey, Dylan, just one thing that kind of implied in this slide, but one of the difficult things about getting into RV parks is the management piece. Jeff was talking about it a little bit. So you have this embedded in-house property manager that kind of lays on top and implements all these things. So you kind of want to talk about that high level and
yeah, sure,
the barrier to entry in the space because of that,
Yeah, definitely. So there are definitely third-party managers in the space, and I don't want to say they're not good, or I don't know them personally, right? I don't have the experience to really talk towards their how they function. I've heard different people come in with all different sorts of like structures and experiences with them. So I would say definitely do your own diligence. I think for us, we believe generally that you're always gonna be best off self-managing, just because it's not the same as an apartment management company, right? If I want to start an apartment management company, I could just manage apartments in Tampa and have, just the most localized team possible that's just crushing it, because I could buy thousands of markets in Tampa, and I think get the economies of scale and the advantages from having that. Whereas within this space, just because there's just just a much lower number of total sites across the country as there is something like apartments, it requires a lot of us to be more regional and sometimes national, right? So there's a lot of flying out to the properties and getting out there and being on site. And we do a ton. We do daily meetings with our managers every morning on Zoom, and then we're constantly, flying out to our properties. We have our, COO and regional. We're in North Carolina this week, Tennessee last week, and it's just constantly flying around, to where I think it would be a tough business to have that be your sole business, is third party managing RV campgrounds in all different states and all different sizes. So I think that by self-managing, you give yourself that sort of ability to ensure that you have full control of the outcome, good or bad, right? And hopefully you can influence it to go in the right direction. So yeah, we're definitely big proponents for that. I definitely think I would say this is just not a, especially if you're getting into anything with short-term sites. I mean, you have to be prepared for this. Like operationally, this is not a super easy business. It's definitely, you have to have sort of like thick skin to be able to, like, if you're not used to seeing winters where your NOI is next to nothing, and then summers where you're flourishing, it takes a little bit to like stomach at first. And to have a third party in the driver's seat that you're not fully confident on, and hopefully you can find one that you are confident on if you're going third party. But if to have someone that you're not confident on, I think would be really tough, because there's just not a ton of options out there. So I would say, if you're going to go third party, at least be prepared to go through the brain damage of managing it yourself, if things don't go as planned. Like, you just have to be in a position in life where you can roll up your sleeves and jump in if things aren't going as planned, because things can turn quickly if you have shorter term leases. And I think it's really important to have a kind of a plan B in place. So that would be my biggest advice, is shop third parties, see if you find someone you align with, but also know, like, you need a plan B, and need to be willing to like jump in. And it's not going to be a passive, I think even if you have a third party, it's still not going to be a really passive experience.
Thanks, Dylan.
Yep. So financing, it's a lot of bank debt. I've signed on 15 different recourse loans in the last 2 years. So definitely harder to find non-recourse. There is non-recourse available, but a lot of times that's more of your takeout option or your refinance option, because you have CMBS as your number one non-recourse option, but that usually has a higher prepayment penalty. So usually when you're going on these value add deals, you start with recourse, banks that are more flexible, lower prepayment, drive value, and then refi into the non-recourse. There also are life insurance companies that can be non-recourse. And I'm starting to see some different non-recourse debt funds pop up for the RV space as well. So there are options out there, but a lot of it is recourse, especially for your going in loans. The typical financing is usually I'd say up to 75%, but it's usually more like up to 70% loan to costs. And a lot of times it's more 70% loan to value. And you're usually able to get 5 to 10-year fixed rates. So it's all about just building good relationships with banks, right? We have one bank we've done 8 deals with so far. We're doing number 9, number 10 right now simultaneously. We have just a great connection with them, put a lot of trust in them, got a just really, really good synergy. So I think it's just finding a, you know, really good bank you can align with to grow with. Markets, you know, target at least 100,000 plus population. Actually in the RV space, it's more common to look at what are you within 2-hour drive radius from. I don't love that as much just because I don't want to be in a tertiary location that's 2-hour drive radius from other places unless there's something really, really interesting about it. You know, again, like maybe it's oceanfront or, you know, on a lake with a marina or something like that. But I like to be within an hour. If it's not, you know, on body water, probably within an hour tops of a, you know, major market, I think is helpful. Just because I don't want someone building something closer between me and that market that kind of puts me at risk. So I think the closer the better, and I really like optionality. If you can convert it to affordable living in a down scenario, I think that, you know, provides everyone with a lot more comfort. Diverse employment bases still can be helpful for, of course, for MH, and then for RV, you know, in the workforce housing specifically, that's extremely helpful. And I just put we're primarily Southeast in Texas. We actually don't own in Texas yet. And you know, Texas is just, yeah, we're still figuring out which parts of Texas we really want to target. But the yeah, we're definitely hopeful to get into there at some point. And Southeast, we're, you know, very open to all states throughout the Southeast.
Hey, Dylan, I was going to say, you know, you have agency here, but really that just applies to mobile home parks, right?
That's right. Yeah. Agency does not work for campgrounds, unfortunately. So
Yeah.
not yet, right? Not until they see that everyone's living in campgrounds in
Right.
in the future. Okay, so we have yeah, this is a great point. Jeff, hope you don't mind me sharing. Just mentioned that he's got a campground in their company. In 2009, when gas prices went high, they found that the campgrounds further away from the city got hit the worst. 60-minute drive from the city campgrounds did okay, right? So I think that's a great point, and definitely agree, right? When gas prices are going up, we want to, you know, the closer we are to the city, the easier it's going to be. And that's also why we like the long-term sites, because you know, your car is going to use a whole lot less gas going back and forth to the you know, to the camper than driving the camper to the site every weekend. So Nick, what do you think? You want me to cover this slide on some of the risks, or do you want to open up for more Q&A?
Yeah, maybe one or two of these, kind of the top.
Sure.
Two.
Yeah, so I think I probably touched on a couple of these along the way, frankly, but you know, let's just talk broadly towards a few of them. You know, recession. I think we hit on the, you know, of course, the MH being very, very, very resilient. RV actually tended to be resilient as well. As I went to review a lot of the annual statements from Sun and EO last, you know, from 2008 down to like 2011, and you can see that I think that is where they become very also bullish on sort of that long-term annual site agreement model, because they start to really report quite a bit on their annuals, and their occupancy percentages remained high throughout that time period. And you know, so between that and then just our, you know, anecdotal working with folks from the campground industry, you know, they've done well, but I think it's all about location, and the actual use of the campground that you're looking at. Inflation risk, you know, we think that payroll is our biggest risk on the campgrounds right now. I think payroll is a risk everywhere. So definitely budget accordingly. Thankfully, insurance is very minimal on campgrounds. And most of your other costs are pretty fixed. But I think payroll is the biggest risk, right? So just being really thoughtful on that and making sure you're budgeting ahead of time. The natural, I mean, operations risk, we already talked about for the most part. Natural disaster risk. So with the MH, natural disasters are big. I would definitely be cautious about having too much coastal exposure. And if you're gonna have coastal exposure, realize you're gonna be paying a lot of money in insurance. So you have to be, factoring that in, especially if you own some of the homes. That's kind of our strategy, is we keep some of the homes and we put a ton of insurance on them to make sure we have, the cash available if something hits. But what I love about RV campgrounds is that you can buy these coastal areas that are really attractive locations to go out and visit, and not have to worry about if major storm or hurricane comes up, because it's as simple as just telling your guests to leave for the week, or like giving them a notice of the upcoming storm, having them evacuate, and then being able to come back after things settle down. I mean, we've seen that in practice before, many campgrounds that we visited, toured, done diligence on, etc. They weather quite well, and that your insurance is usually pretty minimal for that. And it's also very common to see campgrounds in flood zones for that same reason, because you don't want to build an apartment building, and definitely not a mobile home park in a flood zone, because you don't want the damage to mobile homes, which are quite fragile to begin with, and then apartments, of course, have their own challenges there. So I think with the campground stuff, it's definitely more common. We've seen a lot of institutions buy in areas that are exposed to flood zones, probably because the land is cheap and it becomes the highest and best use, because they realize that, practically speaking, in the event of higher sea levels because of a storm or something like that, the campers can drive off and come back and so on. So I think that is something that we've observed. Private utilities, we think we spoke about those a little bit. I won't go super deep, but we're okay with private utilities as long as you do a lot of homework and really understand them inside and out. Septic tanks primarily are if we're going to deal with any form of like sewage system, we would take septic tanks over treatment plants or lagoons. We've done 2 treatment plant deals. We've done a lot of septic tank deals, and we've done some well deals. It's either well water or city water, and we're mostly city water and septic across the portfolio, but we do have some that are city water, city sewer. We do have some that have alternative setups. But septic tanks can be fine as long as you inspect them all. Usually we like to have a high ratio of number of tanks to number of campers or number of homes. That way, if one tank goes bust, you don't have 20 people calling you in the middle of the night or something like that, right? So, and you want to always make sure you have the ample replacement area for the septic tanks. So promise you, if you get into MH or RV, you will learn private utilities, and then you can make your own decision on what the right strategy is for you. We hit on rising gas prices and rising interest rates. I mean, those are a risk for all real estate, but thankfully when you're buying, we usually try to be definitely over like a 9 cap after improvement, at least on the RV side, and sometimes well above that if it's short term. And on the MH side, trying to get to more of like a 7 cap, but I think it's a very stable income. So even if interest rates do rise, I think you have a decent enough spread to where you shouldn't deal with too much of a risk of the inverse relationship. But again, I think it's also a function of inflation. If they keep going, inflation should help us along the way as well. But I think that's something that everyone's sort of trying to make sense of. I think that's where multifamily or even mobile home communities at market pricing can be a little bit tough right now, is cap rates are lower than interest rates in some areas still. So it's trying to kind of find what still works for you. So I'll just let's share this as like a sample deal. This is just 2 deals we closed on a few months back. So we've already been going off and operating these properties, but this was an example of pretty kind of common, I would say, mom and pop purchase deals that have a lot of upside. So this was one where we have an existing 137 site down the road from these, and now we've bought both of these, and we actually just closed another one in this area. So we have 4 parks that are about 400 total sites, all within 30 minutes of each other. And they all sort of play a little bit of a different role in terms of the portfolio. But when someone calls in to this area, it's Sneads Ferry, or it's the Jacksonville MSA, and kind of going down right north of Wilmington. When someone calls in, they'll call one of our places, then they call the next one of our places, and the next one of our places. So we have this, we joke around called little monopoly forming there, where we have all like the major campgrounds that pop up, which is great because we have one of the deals in the top right is more waterfront. It's got 14 wet slips. It's got a private boat launch that will charge over $1,000 a night. It's got a nice short-term rental, so higher yield. We'll probably run that one with 30% short-term sites that'll do high cash flow, and then the rest more of a steady eddy long-term. And then we get a lot of like class A, $300,000 RVs going in and out of there just because of its location. And then the one at the bottom was all ran, it was 6 and 6. They paid every 6 months. They were paying like $250 a month. We've brought everyone up to 400. For those that left, we've been filling them back in at 525. And we're adding a bunch of amenities. We're adding a bathhouse, a laundry room, a fire pit area with string lights and Adirondack chairs, and probably do either pool or hot tub. We're looking at a lot of different value add options on that one. So yeah, but I think that one's going to be more of a sticky middle of town. This is for people that don't want to pay the premium to be on the water, but they like the sort of the proximity. And these people, again, it's coastal North Carolina, so they're coming from Raleigh-Durham, from Charlotte, Wilmington. You'd be surprised, kind of the range of different people you get in here. But that's a prime one that would also be perfect for affordable living. If we needed to kind of pivot and open that up for affordable living, we would have that. But we have another park in the area that we use for our affordable living temporary kind of workforce stays. So we sort of are able to accommodate the different types of people without mixing them all into one mixed bag, because the guys that are there for affordable living don't want to be next to the ones that are partying for the weekend, or vice versa, right? So I think it's important to kind of be thoughtful on the way that you're going to run and manage each of the campgrounds. And you can kind of check out a little bit on the cash flows. You can see it ends up being a little bit less than definitely less than 50% expense ratio over time, but it starts off I think a little bit higher than 1, and we just know this area so well. We have really kind of pinpointed our numbers, and a lot of this was modeled actually to run majority long term. So it's a little bit lower marketing and payroll because we're running the vast majority of these long term. We get some economies of scale there. But you can see the sort of the cash flows over time enter into the the low to mid teens. A lot of times on a long-term campground, we're targeting at least I would say at least 10, usually more like 12, 13 by year 3. And then if it's got a short-term component to it, we like to go higher than that. But really hard to find that kind of yield in today's world. And that's not like a fake yield where you're flushing all this capex below the line, because you have minimal capex. So you're able to have a really high distributable cash flow, which I think it's hard to find many real estate types that are able to produce like that. So yeah, I mean, I think that's the bulk of my presentation. But any other questions, thoughts, comments?
That's great, Dylan. Thank you. Anybody have other questions for Dylan? Okay, so yeah, there's Dylan's contact information. Yeah, this wasn't meant to be like a sales pitch or anything, but he does have a fund that's RV park / mobile home park. If you're interested, reach out.